What happens when you take a tech research giant like Gartner and put it through the legendary Warren Buffett test? Well, that's exactly what we're going to do today. Let's dive in.
All right, so here's the big question we're tackling. Is Gartner a stock that the Oracle of Omaha, Warren Buffett himself, would actually pull the trigger on today? As you're about to see, the answer, well, it's not quite a simple yes or no.
And this really gets to the heart of the problem for any value investor, right? It's a classic tug of war. On one side, you've got this absolutely wonderful company. But on the other side, you've got a price tag that seems to scream, yeah, we know we're wonderful. All that quality, it feels like it's already baked into the price. It's the age-old debate. Great company versus a great investment.
Okay, so first things first, let's just focus on the quality part. We're going to break down exactly why Gartner is considered such a fantastic business, looking at it through Buffett's first three big tests: the business, the management, and of course, the financials.
And look, when it comes to the quality test, Gartner just knocks it out of the park. I mean, it's business, it's management, it's financials, all scoring excellent or strong. Seriously, for a value investor, this is the kind of report card you dream about finding. So let's talk about its competitive advantage, what Buffett famously calls the moat. And Gartner's moat is, well, it's huge. If you're in the tech industry, you know the Gartner Magic Quadrant is not just a report, it's the gold standard. People live and die by it. This gives them insane brand power, makes it a real pain for clients to switch to a competitor, and creates this amazing network effect. The more clients they get, the better their data gets, which just pulls in even more clients. It's this beautiful self-reinforcing cycle. All right, next up, management. This is where so many great businesses fall apart, right? But not Gartner. This quote here says it all. Their leadership team, they are just brilliant at allocating capital. Think about it. For every single dollar they keep and reinvest in the company, they create way more than a dollar in value for you, the shareholder. That right there is the sign of a truly world-class team. Okay, now let's talk about the money, the cash. This year, Gartner's on track to pull in over $1.1 billion in free cash flow. And just so we're clear, that's not revenue. That is cold, hard cash left over after they've paid for everything. This company is an absolute cash-generating machine. And if you need any more proof of how insanely profitable this business is, just look at this number: an 87% average return on equity over the last 5 years. To put that into perspective for you, Buffett gets really excited when he sees a company consistently hitting, say, 15, maybe 20%. 87%? I mean, Gartner is playing a completely different sport here. And what's really amazing is that it's not just profitable, it's getting more profitable over time. You can see its operating margins are expanding. That tells you it has incredible pricing power, and it just gets more efficient as it gets bigger. It's like a snowball rolling downhill. It just keeps getting stronger and bigger. So, I mean, everything sounds perfect, right? You've got the wide moat, you've got brilliant management, you've got incredible financials. It seems like the total package. But you knew there was a but coming, didn't you? There's a catch. And that brings us to the final hurdle, Buffett's fourth and most important rule, the one that separates a wonderful company from a wonderful investment. And that, of course, is the price. Now, before we look at the numbers for Gartner, we have to talk about this concept, the margin of safety. This is the absolute cornerstone of value investing. All it really means is that you buy something for way less than you think it's actually worth. That discount, that's your safety net. It's your buffer for when you're wrong, and it's where all the real money is made. And here's the issue. The analysis estimates that Gartner is intrinsically worth somewhere between, let's say, $430 and $480 a share. Okay, so where's the stock trading today? Around $475. You see the problem? It's trading right at the tippy top of its estimated value. There's just no discount. There is zero margin of safety. And this is really the key point here. When you pay full price, even for an amazing company, you're basically betting that everything is going to go perfectly. Any little stumble, any hiccup in the economy, and you're exposed. It's so important to remember, a wonderful company is not automatically a wonderful investment if you overpay for it. Okay, so let's bring it all home. We've got this fantastic, high-quality business on one hand and a full, maybe even premium price tag on the other. So what does this actually mean for you as an investor? The final verdict here is actually two different verdicts, depending on who you are. If you already own shares of Gartner, the analysis says, hold on. But if you're a new investor thinking about buying in today, the advice is pretty clear. Avoid it. For now, anyway. And the logic here is really straightforward.
If you're already in, why would you sell a phenomenal business that's just going to keep compounding your money over time? You hold on to your winners. But if you're on the outside looking in, the current price just doesn't give you any protection or much room for growth. For you, the name of the game is simply patience.
So, what does patience actually look like in practice? Well, the analysis gives us a pretty specific target. A really attractive entry point, one with that margin of safety we talked about, would be somewhere below $345 a share. See, that's the difference between paying a fair price and getting a wonderful price. And that really leaves us with the ultimate dilemma for any value investor, doesn't it? What's the bigger risk? Being patient and maybe, just maybe, missing out if the stock never comes down? Or jumping in now, buying a perfect company at a perfect price, and leaving yourself absolutely no room for error? That's the question at the heart of it all. Something to think about. Thanks for tuning in.